Hello, everyone, and welcome. I'm Rick Buczynski, Chief Economist at IBISWorld. Today's webinar is a continuation of both my April 29th and May 5th installments. I suggest you check these out if you haven't already. In these, I provided some guidance for how well industries are positioned for recovery after the COVID-19 crisis fades. I employed several historically based metrics to help in this assessment. The first was an industry volatility metric. The second was a risk trend prior to the COVID-19 crisis. And finally, the third was a calculation of the compound annual industry revenue growth rate during the last cycle, that being the 2007 to 2010 period. The theme today will focus on several industry groups that are not well positioned for recovery. As you'll see, in many cases, history provides little in determining an industry's outlook going forward. So we'll just have to rely on good old common sense. And like the previous webinars, there's a huge amount of data here, so avail yourself of the many tables I have included. In short, take a closer look. Before I start, I thought you might be interested in a special report Dan Spitzer recently wrote that appears in IBISWorld's Industry Insider. It's all about the Paycheck Protection Program. I'm sure a lot of you are interested in that. What you see here is an allocation chart from that piece, although given pending aid legislation, the amounts and distributions will surely change over time. You still might want to check this out and other IBISWorld COVID-19 related articles available now and in the future. You can do so by simply registering online for our Industry Insider. For convenience, let me introduce some Bureau of Economic Analysis data from my last two webinars. Here, the middle column shows the average peak to trough in industry value added for 11 recessions since 1948. I sorted this from worst to best, along with the compound annual growth rate of revenue from the previous cycle, which appears in the right-hand column. This is very useful stuff in both comparing and contrasting the current situation from past cycles. Maybe a test of how good your memory is. In the last two webinars, I discussed 8 industry groups in some detail, those being farming, construction, machinery, primary metals, wood products, fabricated metal, and non-metallic mineral products, plus petroleum and oil. Today, I'll explore 7 additional groupings: motor vehicle manufacturing, the related car dealer segment, computer and electronics makers, electronic equipment manufacturers, the trucking industry, and transportation support activities. So how is the motor vehicle industry positioned now? Well, American automobile and parts manufacturers live in a highly volatile environment characterized by, as everybody knows by now, loads of overseas competition, actually for decades. Hence, by IBISWorld measures, they are currently facing a very high risk intensity. Look at the table. Add to this, there has been considerable overproduction prior to the COVID crisis and a collapse in the sedan market. A few months ago, I bought a brand new Honda, cheap, that was sitting on the lot for a couple of years, only 60 miles on it. Moreover, supply chain issues have beset the parts industry in particular, and there's not likely to be a cash for clunkers program this time around. By the way, this distorted a bunch of data during the previous cycle. SUVs and light trucks might fare relatively better than the rest given low gas prices. I discussed oil and gas in a previous webinar. As for car dealers, sales of used cars always outpace new car purchases during economic recoveries, especially sluggish ones. Many segments of computer electronic products are not at all well positioned for recovery. Note the numerous very high risk intensity categories of these businesses. In fact, many were already on an increasing risk path prior to the COVID-19 pandemic, making a potential recovery arduous at best. And obviously, internet streaming and digital deliveries have been crushing recordable media producers for years. Remember what I said in previous chats. Downturns often accelerate structural changes that are already underway. Even in industries with medium risk intensity on this table find themselves increasingly exposed to trade-related pressure from overseas imports. So perhaps these metrics are underestimating their peril. Similar risks are faced by many electrical equipment, appliance, and components businesses in that they are inordinately exposed to international trade pressures. So even the medium risk intensity industries listed here are vulnerable. Take heed, take precautions if you are involved in this space. If we consider some of IBISWorld's forward-looking risk metrics as found in our industry early warning system, lighting and bulb and lighting fixture manufacturers, as well as electrical equipment makers, find themselves in high to very high risk categories through the end of even next year. Clients of our early warning system might wish to download the file from our website as it was updated just last week. So moving on, how about furniture and related product manufacturing? See the short list here, all correlated to housing construction. I spoke about this in my April 29th webinar and in not particularly glowing terms. Although with low mortgage rates and the government pumping billions of dollars into consumers' pocketbooks and into construction business aid. By the way, see the second slide above on the PPP again. Perhaps I'm being overly concerned. Regardless, this hinges on your business footprint and the shape of the recovery, as I discussed in my last webinar. Note that household furniture and blind and shade manufacturing are significantly exposed to international competition. And IBISWorld's forward-looking risk rating forecasts don't bode well for either over the next 2 years. Next, let's consider the trucking industry. There are no clear red flags historically. Seems pretty mundane by this table. Not surprising, since this sector is highly correlated to overall economic activity and tracks business cycles very closely. However, given the likelihood of a serious economic downturn this year and prospects of, at best, a sluggish rebound in 2021, the prognosis for trucking isn't all that optimistic. Plus, the industry is held back by a lack of qualified drivers. And moving companies' performance clearly depends on the housing market, which, as mentioned, is highly uncertain at the moment. And finally, what about transportation support activities? Aircraft maintenance and auto towing both have high risk intensities, but there is a clear difference between the two going forward. The airline industry is likely in for a long slog, so the maintenance of aircraft will follow suit. On the other hand, auto towing companies can recover, at least potentially, fairly quickly once social distancing policies are relaxed. And if we look at IBISWorld's forward-looking risk scores in our early warning system, dry docks, cargo inspection, freight packing, and logistics services don't look particularly promising, at least over the next year or two. Well, that's it for today. Hope to see you in the next 2 editions of this series that will be posted next week. I'll stick with the same theme, but promise a few surprises. Stay safe and Godspeed.